Hi friends, I'm just recording an initial intro video. I'm starting with a series where I plan to discuss MTPs, RTPs and suggested answers of AFM. Few pointers for you. Whichever RTP I discuss, you should be first aware of concepts. These RTP are for quick discussion. MTP, RTP, anything I discuss. So you should be aware of concept. You can, after you're aware of the concept, you can use these videos to understand quickly the MTP, RTP discussion. So that is the objective with which we are going to discuss, or we are starting the series. So you can be aware of the concept, or you keep my concept book ready, and whatever questions I am discussing, please read the question at your end and then only see the video. So that is one basic request from my side, because this will go at a normal pace into 1.5 times or at least 1.8 times, because I'll be solving it. You will only be in listen mode. So it will be at a slightly higher pace. So if you are aware of the concept, it will become easier for you. The entire series which we do, it will be like this. So you will be aware, you will be finding it useful if you are aware of the concept, if you are aware of the concept. So whatever MTP, RTP I take, for that you need to be aware of the concept and then only see this video. So please keep the concept book handy with you, or you go through the concepts and then only please do it. Go through any question which I discuss. You have to first go through the question. You should go through the question at your end and then start watching the video. I'll be giving detailed timestamp for every question. So if there is an RTP I'm discussing, and in that RTP you are aware of few questions, please don't see that again. Don't see that again, because time is very critical. Time is very critical. If you are aware of a question, please skip that question and go to the next question. In the timestamp, click the respective question and go to the next set question. If it's a very new concept, I may explain in detail. Otherwise, very simple explanation. Detailed timestamp will be there. You please go to the respective question which you want discussion. Don't waste time on going through the entire part. With this, I now move to whichever RTP we are discussing, RTP, MTP, or suggested answers, whichever I'm discussing. Have a good learning process. Thank you, friends. We are now getting ahead with the September 25 RTP for AFM subject. Question number 1. It is on capital budgeting. We will read the question. But before that, if you want, you pause the video, go through the question and then come to my explanation. Let's start the question. ABC Limited plans to invest 16 lakh in a new unit. Project will have a life of 4 years. No salvage value at the end of its life. Annual depreciation is rupees 4 lakh. Revenues and cost for the project ignoring inflation is provided as follows. Revenues, cost. BC Limited is subject to a corporate tax rate of 60%. Cost of capital including the inflation premium is 10%. Depreciation provides a tax benefit, and inflation rates for the revenues and cost. So it is a question on inflation and capital budgeting. They have given initial outflow 16 lakh in a new unit, 4 years life. So per annum depreciation is 16 lakh divided by 4. 4 lakh rupees is the per annum depreciation. Revenue has been given ignoring inflation. We have two types of cash flow concepts you should be aware of. Else you will have to go through my concept video. I'll explain only the core thing. There are two types of cash flow. One is called real cash flow and second is called nominal cash flow. In this question, we have real cash flow. Why real cash flow? Because ignoring the inflation aspect. Ignoring the inflation aspect, you have real cash flow in the question. They have given cash flows. There's a corporate tax rate of 60%. Cost of capital including the inflation premium. Including the inflation premium. So the cost of capital, the KO can be of two types, real and nominal. In this case, the cost of capital includes the inflation aspect. So that is technically called nominal cost of capital. I have nominal cost of capital. I have real cash flow. Consistency is needed as far as the concept is concerned. Then they have given inflation rates for each year. Revenue, year 1, 2, 3, 4. Revenues and cost, inflation. They have asked us to answer a lot of things. Basic thing we have to do is we'll have to calculate the NPV. I'll directly explain the NPV computation. Automatically everything will get calculated here. Point is, there is inflation in the question and the inflation rate is different for revenues, different for cost. Also, it is different across years. In this case, you have to convert your real cash flow into nominal cash flow. by considering the effect of inflation. It says ignoring the inflation effect. We'll have to consider the effect of inflation and do the calculation. Let's quickly do it. Working note 1. We have a working note 1 which is initial outflow. Initial outflow is how much are we spending on the project. Particulars, amount, capital expenditure. I have to do an initial capital expenditure for the project. The capital expenditure for the project is 16 lakh. This is my initial outflow. Initial outflow is 16 lakh rupee. Working note 2, in between flows. What is in between flows? Every year, what amount are we going to receive? Particulars and 4 years. We have been given cash flow for 4 years. Year 1, year 2, year 3, and year 4. 4 years cash flow. You cannot solve it along with me and all because I'll be going at a little faster speed. Focus is more on quickly getting you the clarity. You want to solve it, you solve either before or after I do. I start with revenues. The revenues for the year 1 is 12 lakh. What is adding the effect of inflation is 12 lakh plus 10 percentage for the first year or into 1 plus the inflation rate. 10% is the inflation for year 1. Year 2 is 9%, then 8, then 7. So first year 12 lakh into 1.1, 10% inflation. Second year 14 lakh. First you have to give effect to first year inflation, then second year inflation. It's like time value of money. Here 2 years inflation effect has to be given. When we do 1 year time value of money, we do 1 plus r. 2 year we do 1 plus r square. 3 years we do 1 plus r power 3. 4 years we do 1 plus r power 4. So 14 lakh you have to give effect to first year inflation that considers the effect of year 1, then the second year inflation. So 14 lakh into 1.1 into 1.09, then 16 lakh into 1.1, 1.09 and 1.08. Then year 4, 16 lakh into 1.1, 1.09, 1.08, 1.07. Give effect to every year inflation. Every year inflation. If any calculation error happens, that's okay. I am quickly trying to do it. Revenues is done. Then less cost. Cost also you'll have to give effect to the inflation. 6 lakh, 12% increase. So 6 lakh into 1.12, then 8 lakh into 1.12 into 1.1, then we have 8 lakh into 1.12, 1.1, 1.09, and then also add 1.08. Difference between this, I have not done any rounding off here. Okay, that's okay. Less depreciation. Depreciation doesn't have any inflation benefit. 4 lakh rupees is the depreciation charge. I can write the same 4 lakh only. 4 lakh is the value, and this gives me profit before tax. Profit before tax. Then deduct tax at the rate 60%. Tax is at the rate of 60%. I will keep doing the calculation. In case you want to detail calculation, please pause the video and do the calculation. Tax at 60%. Profit after tax. Add back depreciation. Cash flow after tax. Add back depreciation. Cash flow after tax. This gives you the cash flow for 4 years. Cash flow for 4 years. And I do not have any terminal inflow. There is no salvage value given, and asset is also fully depreciated. So we calculate the NPV year, cash flow, cost of capital is 10% including the inflation, PVF at 10%, DCF 4 years, year 0, 1, 2, 3, 4. First year 499, 200, 499, 200. Sorry, first I write year 0 number, which is negative 16 lakh, 499, 200, 517, 200, 639, 027, 662, 662. Again, I'm repeating, this is a quick explanation. We do not want to spend time on lot of time because time is very precious. I want to cover it as fast as possible so that you quickly understand it and then keep proceeding forward to the other MTPs and RTPs. 10%, 1 divided by 1.1. We normally do 3 decimal. You can do 4 decimal also. DCF is multiplication, cash flow into PVF, and the NPV is 213,487. Broadly, this should be the answer. Let's look at this. Depreciation tax benefit. Depreciation is 4 lakh. Depreciation is 4 lakh, but the tax benefit on that is 60%. Tax benefit is 60% of that. Tax benefit is 60%, so 2 lakh 40,000. Revenue of year 2. Revenue of year 2 we have done 1678 600. Inflow of year 1 after adjusting inflation and tax benefit on depreciation. Inflow of year 1 499 200. Inflation adjusted cost in year 2. Adjusted cost in year 2 985 600. Okay, they have not asked for everything. Present value of inflow of year 3. Year 3 present value 479 479 909. Some rounding of difference can be there. 479 898. Tax benefit 479 910 rounded off to 479 898. Maybe number of decimals could be different. This is the question on capital budgeting. Question 1 is done. Okay, now I move to question 2. It is a new question as far as my material is concerned. In a recent board meeting of N Limited, following financials of N Limited for the year ending 31st March were presented. Equity capital, 10% bonds, sundry creditors, bills payable, other current liability, fixed asset, cash, debtors, and closing stock. Income statement is given. Sales, COGS, material cost, wage cost, and factory overheads. GP is 365 200. Selling and distribution cost. Administrative cost is given. Earnings before interest and taxes. Interest charge. Earnings before tax. Net profit. Everything is given. During the board meeting, Director A said that the company can maintain a certain profit even though the net profit, certain growth, even though the net profit margin remains constant. Assets increase proportionately to sales and it distributes 30% of its net profit. It will not require any external funds. So, Director A is talking about growing without taking any external funds. 70% they will retain the money, 30% they will distribute to the shareholder. Director B proposed that just by maintaining a target capital structure is debt equity ratio, and without issuing additional equity and maintaining the target dividend payout ratio, more growth can be achieved. What he is talking about is maintaining a target capital structure. What is target capital structure? Debt by equity. Equity portion will automatically increase because of retained earnings. So debt portion can also go up. The first director is not talking about taking any money. Second director is talking about not raising any additional equity, but he is talking about maintaining a target capital structure, which will indirectly have that the person is going to bring, or the company is going to bring in fresh funds. The company is going to bring in fresh funds in the form of, the company is going to bring in fresh funds in the form of debt. Debt can increase because retained earnings is going up. Director Sito agreed with views of Director A, is of the opinion that coming year sales will increase by 15%. Hence, he is saying we should go for issue of equity shares, bonds, or debenture. So, three people have different view. Director A is talking about something called as an internal growth rate. What is internal growth rate? Is growing with the available retained earnings, are growing with the available funds. Director B is talking about a more important concept called sustainable growth rate. What is sustainable growth rate? Is the growth rate wherein I do not issue any new equity. I do not issue any new equity, but I have a target payout ratio. I have a target capital structure. So if retained earnings go up, I can take more debt. I can take more debt. So the first guy is talking about internal growth rate, maximum without external financing. Here, I don't issue any new equity. But because of the target capital structure, when equity increases, debt can also grow along with that. Director C is talking about external funding requirement. He is saying, no, let's go for, we have a problem on EFR in the material. I can go for issue of equity shares, bonds, debentures to achieve the growth. So third guy is talking about external funding requirement. That is, I will have to go for more funds from the market so that the growth which I am planning can be achieved. Question number 4. If we go by the proposal of Director C, then approximately how much funds how much funds shall be raised in form of equity or debt, shall be raised in form of equity or debt, assuming that dividend as proposed by director A, dividend as proposed by director A, director has proposed for 30%, he has proposed for 30%, and assets and current liability are increased in the same proportion as increase in sale. So how much funds I have to raise from external equity or debt? The retained earnings part is already there. So today I have something called as capital employed. What is capital employed? Is all assets minus the operating liability or equity plus reserves and surplus plus bonds. So 7 lakh 70 minus 66,000 minus 88,000 minus 44,000. This is the capital employed today. Capital employed is all assets minus the operating liability. All assets 7 lakh 70,000. In this, I deduct the operating current liability related to operation, because this will give me what is the net asset in a company: 44,000, 88,000, and 66,000. This will give me capital employed. Capital employed, you can say capital employed is also equal to equity plus reserves plus debt plus preference. So capital employed is this much. On this, there will be a 15% increase, because the question is saying revenue are going to increase. It's expected that sales will increase by 15%. If sales increase by 15%, you will see an increase. You will see an increase in the current asset and current. That's saying assets and current liability will increase in the same proportion. So this is the net assets after removing the current liability. Increase in capital employed, 15% increase. This much is the funds I need. 85,800 is the funds I need. But a part of funds will come from retained earnings. A part of funds will come from retained earnings. Balance has to come from outside. What is going to be retained earnings? The retained earnings portion is whatever profit we made. This profit will also go up by 15%. Assuming revenue goes up, profit will go up by 15%. 61,600 plus 15% into 30%, we are going to distribute. 70% we are going to retain. 70% we are going to retain. 30% distribute. 70% retain. 70% retain. So retained earnings is 61,600 into 1.15 into 0.7 into 61,600 into 1.15, 15% increase in revenue. 70% you retain. 70% you retain. So external fund requirement is 85,800. Removing this item, I still need 36,000, 212,000. I will still need 36,000, 212,000 from the outsider. A good concept. External funding is what we have done. A question where in this external fund we will evaluate how much will come from equity, how much will come from debt, how much will come from preference. So this is on question 2. Okay, comes question 3, which is on technically called as convertible instrument. Here it is a convertible preference share. XYZ company has current earning of 3 per share with 5 lakh shares outstanding. 3 per share with 5 lakh share outstanding means 15 lakh is the PAT. 3 per share with 5 lakh shares outstanding, 15 lakh is the PAT today. PAT, sorry, not EAES, it is PAT or EAS, whatever way. Company plans to issue 40,000 7% convertible preference share of rupees 50 each at par. 50 each means every share will have a preference dividend of 7% of 50, 3 rupees 50 paise. Preference share are convertible into 2 shares for each preference share held. You can convert this into 2. Equity shares has a current market price of 21 per share. Conversion value means the value of the instrument once conversion happens today. So this can get converted into 2 shares of 21. 2 shares of 21, 42. 2 shares of 21 equity. It can get converted today. If it gets converted today, 2 into 21, 42. But what are we paying? We are paying 50. Extra 8 is premium. 8 per preference share, 8 per preference share, 8 per preference share, You can also divide by the number of equity shares and say per equity share 8 per preference share. We normally do it for a bond, 8 per preference share, 4 per equity share, 4 per equity share, and it can also be expressed as a percentage. Percentage is 8 on 42, 8 on 42, 19.05% of conversion value, 19.05 percentage. You have to write, if there's no clarity, write per preference share, per equity share, and percentage of conversion value, percentage of conversion value. Assuming total earnings remain same, calculate the effect of the issue on the basic EPS before conversion, after conversion. Basic EPS, moment you issue convertible preference share, there is going to be reduction in the EAES. There's going to be reduction in the EAES. Total earnings remain same. What is the effect? What is the effect on the pre earnings per share? Very simple. Particulars, we have before conversion and after conversion. Before conversion and after conversion. PAT today, because there's no change in PAT, 3 into 5 lakh. 3 into 5 lakh, 15 lakh. If I don't convert, I have to pay preference dividend, less preference dividend, less preference dividend. I have to pay preference dividend. How much is the preference dividend we are going to pay? We are going to pay preference dividend of 7% convertible preference share of rupees 50 each. They've said 7% convertible preference share of rupees 50 each, 40,000. So I have to pay preference dividend of 40,000 into 50 into 7 percentage. And if I convert, no dividend to be paid, no dividend to be paid, this will give me EAES. Obviously EAES will go down, 1360, 15 lakh. Number of equity shares, today the number of equity shares is 5 lakh before conversion, and if you do conversion, your 40,000 preference share will become into 280,000. 40,000 will become into two shares, so it will become 5 lakh 80,000, and this gives me EPS. Very simple question. Divided by this 2.72 and some 2.5862, you can round it off and do. This is in case there is no change in the PAT number, no change in the PAT number. EPS will go down from 3 rupees to 2.72 and some 2.59. In case PAT increases by 1 million, 15 lakh will become 25 lakh. 15 lakh will become 25 lakh. Automatically same calculation. I don't want to spend the time on this. 25 lakh minus the dividend, EAES, divided by number of equity share, and you get the earnings per share. You get the earnings per share. With this, my third question discussion is over. Let's move to fourth question. Following data is available for three bonds A, B, and C. The bond are used by a bond portfolio manager to fund an outflow scheduled in 6 years. Fund an outflow scheduled in 6 years means I need money after 6 years. We have a concept called duration, which has another concept called immunization, immunizing the portfolio. Any concept you need more clarity, please see the detailed concept video. The link of that also I'll give it in the YouTube here. So here I need to immunize my portfolio. If I have to give immunity to my portfolio, I should find a portfolio which has a duration of 6 years. Find a portfolio which has a duration of 6 years. Current yield is 9%, which means in market people are expecting 9%. All bonds have face value of 100, will be redeemed at par. Interest is payable annually. Bond A, B, and C, maturity, coupon rate. Calculate the duration of each bond, and then they're saying portfolio manager wants to put 45% in bond A. How much should he invest in B and C so that he can immunize the portfolio? After the portfolio has been formulated, interest rate change has happened, increasing the yield to 11%. Today the yield is 9%, yield has gone up, duration has undergone a change. Is the portfolio still immunized? Why or why not? And what should be the new percentage so that I continue to immunize the portfolio? So a lot of calculations around this area. I will do bond A in more explanation, bond B and C quick calculation. Bond A, we will calculate duration. For duration, we write year, cash flow, PVF at the discount rate. Discount rate here is 9%, DCF weight, product, year, cash flow, PVF, DCF, weight and product. This is the broader calculation we do to calculate the duration of a bond. To calculate the duration of a bond, it is a lengthy calculation in exam. It will take time. So it's a 10-year bond. I'll have to write the 10-year cash flow. 1, 2, 3, 4, 5. I'll have to write 10-year cash flows. 6, 7, 8, 9, 10. The cash flow is coupon rate of 10%. Coupon rate of 10%. Face value is 100. So 10 rupees. 10 rupees. I cannot write annuity here. 10 rupees every year. Last year 110. Last year redemption at par. PVF at 9%. 1 divided by 1.09. We can do 3 decimal or 4. That's your wish. I normally do 3 decimal. Cash flow into PVF. Cash flow into PVF is the discounted cash flow. Sum is the value of the bond today. Sum is the value of the bond today. So 10 into PVF. 10 into PVF. This will give the numbers for every year and total of this. Total of this is the value of the bond today. What is weight? Duration basically says what is the weighted average time taken. What is weighted average? First year I get 9.17. First year I get 9.17 out of 106.36. 9.17 out of 106.364. I keep it as 4 decimal. So 8 percentage, 0.0862, 0.0862. 8 percentage of my bond cash flow comes in the first year. 8 percentage comes in the first year. Second year, 8.42 divided by 106.36. 7 percentage, 7.92. Like this you have to do every year. The total obviously will add up to one time. Some rounding of differences can be there. It is one time, 0.9999. So I am getting in the first year 8% of the cash flow. Second year 7.92%. Third year 7.26%. 0.0726. 0.0666. Weighted average. What is weighted average? Is 1 into the first year number, 2 into the second year, 3 into the third year. This goes on. This goes on. So 1 into this, 2 into 0.07, 3 into 0.07. Like this it goes on and I get total. I get total. So duration is 6.86 years or 6.8605 years. This is bond A. Bond A is 6.8605. 6.8605. For you it will take a lot of time. I have the benefit of Excel. But I want to quickly explain the concept. You can do your calculation. This is bond A. Then we do bond B. Bond B has a life of 8 years, relatively lesser life, so better. 8 years life. Coupon rate is 11 years, so you get 11, 11, 11, 11, 11, 111. Total is 111.08. I divide by 111.08 here. 111.08. I divide by 111.08. Complete it. Multiplication 5.836. 5.836. This is the duration of bond B. Duration, I can keep it as 2 decimal also. That's okay. ICI may not be consistent in these areas. Third bond, life of only 5 years, makes it little more simpler. Cash flow is 9 and last year 109. Total adds up to 100. Divide by 100. Divide by 100. Divide by 100. Multiplication 4.24. So first bond duration is 6.86. Let me keep it as bond 1 6.86. Bond 2 5.84. Bond 3 4.24. Some up and down rounding of difference. I'm not bothered about it. ICI may deduct marks for this, but we cannot help it because sometimes they do 3 decimal, sometimes they do 4 decimal. Now, I want to keep 45% of money in bond A. Balance 55%. I have to keep it in B and C so that I immunize my portfolio. What is immunity? The weighted average. Weighted average is equal to 6 years. Weighted average is equal to 6 years. What is weighted average? Bond, duration, weight, product. I have 3 bonds A, B and C. 6.86, 5.84, 4.24. 6.86, 5.84, 4.24. There are 3 bonds. The weight of bond A, the weight of bond A is already given, saying that we will invest 45% in bond A, 0.45. I don't know how much I'm going to put in B, how much I'm going to put in C. That weight I don't know. But only thing I'm aware is put together it is 0.55. Put together is 0.55. 45% goes to bond A, 55% will go to B and C. So here we write, let's call this as W1, and this is 0.55 minus W1. 0.55 minus W1. Put together 1. Put together 1. 0.55 minus W1. Multiply this 3.087, 5.84 W1, 4.24 into 0.55 is 2.332 minus 4.24 W1. Total of this has to be 6. Total of this has to be 6. We are investing 6.45% in bond A, W1 in bond B, 0.55 minus W1 put together, which is 3.087 plus 5.84 W1 plus 2.332 minus 4.24 W1 equal to 6. We want this number. This will give the weight of W1. And then I'll show you the checking part. We can check the answer also. Weight of W1. So here I solve this equation now. Plus 5.84 minus 4.24. So I get 5.419 plus 1.6 W1 is equal to 6. 1.6 W1 is equal to 6 minus 5.419. Calculation little bit small numbers, that's okay. W1 is equal to 0.3631 or technically 36.31%. 36.31%. Answer may vary little bit here and there. Investment in A given in the question 45%. Investment in B 36.31%. Investment in C is 55% minus 36.31%. 55 minus 36.31, 18.69. Once it is done, we will check the answer also. Checking is in the calculator you can do. In Excel I am doing it. So 45, 36.31 and 18.69%. How do I check the answer? I'll put here 3631.1869. Do the multiplication. Total should add up to 6. It is adding up to 5.9996, which is 6 years. So to immunize the portfolio, approximate answer is 36.31 and 18.69. Broadly the same answer. It depends on rounding off we are doing. Here if you see, you are getting the answer as 36.71 and 18.29, which is more of a small rounding of differences, because we have worked with duration here. Duration we have worked with 3 decimal in the printed answer. I have done 2 decimal. It doesn't matter. 6.85, 5.83 and 4.25. I got 5.84. So small differences. Let's not worry much about it. That's never my worry, because weight is done 3 decimal. The solution can change a little bit. Then they are saying we are now doing bond A duration has undergone a change, bond B duration has undergone a change, bond C duration has undergone a change. Why did the duration change? The duration has undergone a change because of increase in yield. Is the portfolio still immune? And if not immune, can you immunize again? Now checking immunity, let's put the numbers here. In place of 6.86, it now becomes 7.15. In place of 5.84, it becomes 6.03, 4.27. I get 6.21. Weighted average is 6.21. Portfolio is not immune. You should have got 6, which you will not get because duration has undergone a change. The weights were earlier working because duration was different. Now when duration changes, automatically this is going to undergo a change. So portfolio is non-immune. If you want to make it immune, again W1, 1 minus W1 and then solve it and close it. That part I leave it to you. W1 and 1 minus W1 you do and then get the new weights. Get the new weights. With this, question 4 discussion is over. A very good problem, slightly time consuming area from an exam point of view because calculating duration is time consuming. New weights are going to be different here. New weights are going to be different. With this question gets over. Okay, let's move to question 5, which is on portfolio management. A kind of a simple question only. Equity of KGF Limited is rupees 410 crore. Its debt is worth 170 CR. Printer division, which is having 74% of the value, has an asset beta of 1.45. Balance is spares and consumables division, which has an asset beta of 1.20. Debt beta is 0.24. You have to find out equity beta. This is without tax. With the taxes there, little bit adjustment becomes more. Without taxes, fairly simple. Beta can be computed from asset side of the balance sheet, can also be computed from liability side of the balance sheet. Asset side beta, we have two assets. One is printer division and second is your spares and consumables division. Their asset beta is given, their weights are given. So first we will do asset beta. From asset beta, we will do liability beta, in which equity beta is balancing figure. So working note 1, computation of asset beta. Computation of asset beta. First we do asset beta, where we have 4 columns: asset, beta, weight, product. Asset, beta and weight and product. We have 2 assets which are given. There are 2 division, and asset beta is the weighted average of the beta of the asset side. No extra explanation I'm able to give at this stage. You want extra explanation, you will have to go through concepts. So here we have 2 businesses. One is your printer division. Second is your spares and consumables division. Spares and consumables division. Beta is given for each of the division, which is 1.45, and the other one is 1.20. Weight is 74%, 0.74. Balance is 0.26. Weighted average. Beta into weight is product and a total. So the asset beta is 1.385. Asset beta is 1.385. Asset beta is 1.385. Now we have to do the liability beta. In that liability beta, equity beta will become balancing figure. We'll have to do liability beta. In the liability beta, equity beta will become balancing figure. Working note 2, computation of equity beta. Computation of equity beta. In the equity beta, we have equity and we have debt overall. Equity, debt and overall. The overall beta is 1.385. This is the concept. Asset side beta is equal to liability side beta. Asset side beta is equal to liability side beta. The beta can be valued from the asset side of the balance sheet, can also be calculated from the liability side of the balance sheet. Logic remains same. What you normally do in a business, what you normally do is you prepare a balance sheet. In the balance sheet, asset side is equal to liability side. Same logic will work here. 1.385. Now we have been given 2 values. One is equity value is 410 crore. Debt value is 170 crore. No need to divide by and make it less than 1 time and all. It's okay. 580. ICI gives mark this way itself. Product is column 2 into column 3. 580 into 1.385. 580 into 1.385. So this is the product total. Debt beta is 0.24. So debt product is 0.24 into 170. The product for debt is 0.24 into 170. 0.24 into 170. Now this is a beautiful thing. Product for equity is overall total is 803.3. Deduct 40.8 from that. 803.3 deduct 40.8 from that. Overall total is 803.3. Deduct 40.8. Whatever I'm writing in bracket is for your explanation. No need to write that in exam. 803 minus 40 minus 40, 762.5. Column 2 into column 3 is column 4. So from the product, you divide the weight, you will get the beta. From the product, that is 762.5 divide by 410. Divide by 410. 762 by 410. 1.8598. 1.8598 times 1.8598 times 8598 times is the equity beta, excellent solving, excellent format, quickly gets you the answer. 1.8598 times from the product, divide by the weight and get the beta. Then they have said I am going to make some changes. Ascertain equity beta if decides to change its debt equity position by raising further debt and buying back equity. Debt equity ratio will be 1.9. I have totally 580 CR. In this debt equity, debt is 1.9 times, equity is 1 time. I totally have 580 crore, 410 plus 170. Debt is 1.9 times, equity is 1 time. So 580 breakup is 380 of debt, 200 of equity. 380 of debt, 200 of equity, and they're saying whatever debt you are borrowing extra, that will have a beta of 0.4, and the present debt will have a beta of 0.35. Present debt 0.35, extra debt 0.4. Present debt 0.35, extra debt 0.4. Extra debt 0.4. Present debt is 0.35, extra debt is 0.4. So we will put it in the same format. Overall beta remains same. Liability, beta weight product. I have existing debt and I have new debt. Existing debt and new debt. Existing debt and new debt. Overall is 1.385 into 580. That does not change. 1.385 into 580. What is the breakup? Equity is 200. Existing debt is 170 and the new debt is 380. 380 is the borrowing I'm going to have. 380 minus 170. 380 minus 170, 210. Put together is 510. 580. Put together is 580. Put together is 580. In this, existing debt has the beta of 0.35 in the rework scenario, and new debt will have a beta of 0.4. 0.35 and 0.4. 0.35 and 0.4 multiplication. This is 0.35 into 170 and this is 0.4 into 210. Superb format. And now I go back. 803.3 minus 59.5 minus 84 minus 84 minus 84 and this is balancing figure. 659.8 divided by 200. Don't remember formula, all that doesn't really matter. ICI is awarding marks. It's not that marks are not awarded. They are awarding marks as long as you get the final right answer. Final right answer is very critical. 3.299. So the requirement was calculate the equity beta, whether the new equity beta justifies the increase in value. This I don't know why they asked. There's nothing like this, but they have given some answer. You please follow that answer. I don't see that to be a logical one. Since there is no increase in the value of equity after buyback, it does not justify the increase in equity beta. I really don't understand this requirement. You please follow whatever they have done it in the exam. In case it comes back, it comes in your exam, please follow exactly what they have done. I really don't see this part of the question very logical. They are saying because equity beta will go up whenever you borrow more, risk for equity guys increase. If risk for equity guys increase, their beta will increase. With this question gets over. Okay, we now go to 6A. A rice trader has planned to sell 22,000 kg of rice after 3 months from now. Spot price is 60 and 3 months future price is 59. In the futures market, it's at 59. In the spot market, it is at 60. So we are expecting that rice price can go down, and I plan to sell after 3 months. Size of the contract is 1000. What a trader can do to mitigate the risk of the reduced profit if the price can fall as low as 56 per kg 3 months hence. If you are feeling that price can go down, enter into a futures contract to sell at 59. To sell at 59. How many contracts? 22,000 divided by 1000. 22 contracts. Sell it at the price of 59. After 3 months, price is 56. You will get 56 rupees in the spot market, and the difference between your contracted selling price, which is 59, and the price in the market is your profit. 59 is your contracted selling price, and today the price in the market is 56. You sold it at 59, you buy it back at 56. That's called technically a net settlement. You sold it at 59, technically you buy it back at 56. 3 rupees you will earn in the futures market, 56 rupees you will sell it in the spot market. 56 plus 3, 59 rupees you will get. This is part 1. You will get futures market 3 rupees and 56 rupees you will sell. You will get 59 per kg. You will get 59 per kg. This is in case 56 happens. Now they are saying, suppose the trader wanted to make use of the futures contract. Make use of the futures contract. What will be the effective realized price from its sale when after 3 months? After 3 months, spot price is 57, futures contract price is 58. Futures contract price is 58. Now, futures always go through a net settlement route. What is net settlement route? Is day zero. Day zero. When I entered the contract, there was a spot market, there was a futures market. There was a spot market and there was a futures market. Day zero, the spot price was 60 rupees, 59 rupees. I went and sold it at this rate. I went and sold it at this rate in the futures market. In the futures market. Then I come back after 3 months. After 3 months, I come back after 3 months. After 3 months, what has happened is spot is at 57 and futures is at 58. This gap is called basis risk. This gap, ideally on the last day, spot rate and the futures rate should match. If it's not matching, this risk is called basis risk. 57 is the spot, 58 is the futures. Now, you sold it at 59. First, let's discuss the futures market. You sold it at 59. To calculate profit or loss, you assume you do an opposite transaction 58. You make a profit of 1 rupee. 1 rupee in the futures market. Sold it at 59 in the futures market. Bought it back at 58. Bought it back at 58 to cancel the contract. Sold. You press the sell button and then you press the buy button in the demat account. In the demat account, you sold it at 59. Buy it back at 58. 1 rupee profit. 1 into, I technically do it for 11,000 kg, 22 contracts. I said 1 into 22 contracts into 1000 kg. I make a profit of 22,000 and I will be able to sell the rice only at the actual spot price. Sell the rice at the actual spot price, which is 57. Sell the rice at the actual spot price, which is 57 in the market. Sell the rice at actual spot price, which is 57 in the market. You can sell it only at the spot. Futures always go through a net settlement route. Futures always go through a net settlement route. So my realization is 57 into 22,000. I get another 22,000 from the futures market. Whole divided by 22,000. I earn 58 per kg. I earn 58 rupees per kg. 57 into 22,000 plus another 22,000 divided by 22,000. Divided by 22,000. We exactly get, not approximate, 58 per kg. We effective realization is 58 per kg. Clear? With the 6A is done, I move to 6B. Company is long on 10 metric ton of copper at 534 per kg. Intends to remain the same for the ensuing quarter. Variance of change in the spot and the futures. I need SD, not the variance. You will understand as we discuss. Having correlation coefficient of 0.75. Contract size of one contract is 1000 kg. One contract is 1000 kg. calculate the optimal hedge ratio. Optimal hedge ratio is beta. Beta had a formula called standard deviation of spot divided by standard deviation of futures into correlation spot futures into correlation spot futures, standard deviation of spot, standard deviation of futures into correlation of the spot market with the futures market. This is the formula to calculate beta or hedge ratio. Hedge ratio, what is hedge ratio? Is the ratio between the spot market and the futures market for hedging. Spot market standard deviation is 16% is variance, so 4, 36% 6 into correlation 0.75, 0.5 times is the beta. 0.5 times is the beta. The beta is 0.50 times. The beta is 0.50 times. That is the beta we are following. Beta is equal to 0.50 times. Then they are saying advise the position to be taken in the futures market. In the futures market for perfect hedging. For hedging, what is the position to be taken in the futures market? In the futures market. So if you are long in one market, you have to go short in the other market. You have to go short in the other market. Long in one market, you have to go short in the other market for hedging. Short in the other market. Number and the amount of copper futures. We have a standardized format for this also. We have a format which says security beta weight product. Security beta weight product. This is the format we use. Security beta weight product. This format will help me in computing the amount of contract. Security beta weight product. Copper futures. Copper has beta of 0.5. Futures normally will have beta of 1 time. So copper futures is 1 time beta. We are currently long on 10 metric ton of copper. 10 metric ton of copper at the rate of 534 per kg. So 534 into 10 metric ton is 10,000 kg. 10 metric ton is 10,000 kg. So 53 lakh 40,000 is the investment we have made. Product is beta into weight. It's a very standardized format. So you get 26 lakh 70,000. Let me check. 5340 into 0.5. 5340 into 0.5. 2670. Copper futures 2670. Overall total has to be 0. Perfect hedge means overall total has to be 0. 2670 negative. 2670 negative. And this is last column divided by beta. Column 2 into column 3 is always column 4. Negative 2670. So I should sell. Negative means I should sell. Amount of copper futures to be sold. Negative 26 lakh 70,000. Amount of copper futures to be sold 26 lakh 70,000. They wanted number and the amount of copper futures. Amount is 2670. Number is very simple. Value of one contract 1000 kg. Ideally, I should multiply with futures price. I do not have data in the question, so I multiply with the spot price. One contract is 1000 kg and each kg is 534. You should multiply with futures rate. We do not have data. We cannot calculate also here. So 1000 kg into 534. 53 lakh. Sorry, 5 lakh 34,000. 5 lakh 34,000. Number of contracts to be sold 2670 by 5 lakh 34,000. 5 contracts. We have to sell 5 contracts. We have to go for sale of 5 contracts. That will take care of the requirement. 5 contracts are to be sold here. With this, discussion of 6B gets over. Okay. Question 7 is on interest rate risk management chapter. And normally an area which students find it little difficult. So maybe I'll explain little bit more than what I've explained the earlier set of question. Electra Space is a consumer electronics wholesaler. Business of the firm is highly seasonal in nature. In 6 months of the year, I have huge cash deposit, and especially near Christmas time. Another 6 months I face cash crunch. So 6 months I have money, 6 months I face cash crunch. It's expected that a firm shall borrow a sum of 50 million, 5 CR euros. Euros doesn't matter, any currency. For the entire period of slack season is 6 months. I'll borrow for 6 months in about 3 months. So I'm going to borrow from end of month 3 to end of month 9. I'm going to borrow from end of month 3 to end of month 9. My borrowing is going to be from end of month 3 to end of month 9. So I technically need a 3 by 9 FRA. 3 by 9 FRA. End of month 3 to end of month 9. End of month 3. 6 month borrowing. I want to borrow for a period of 6 months. That is for the entire period of slack season. Slack season is for a period of 6 months. So I want to borrow from end of month 3 to end of month 9. End of month 3 to end of month 9. 3 month futures contract we'll see later. How an FRA is useful if the actual interest rate after 6 months, there is a mistake here, it should be after 3 months. I think I made a mistake in typing. After 3 months turn out to be interest after 3 months, because I'm going to borrow after 3 months, 4.5%, 6.5%. So how FRA works is, let's take the calculation. If it is 4.5 and 6.5, what happens? Particulars actual interest of 4.5%, actual interest of 6.5%. Pay interest on loan. How much I have to pay? I am going to take a loan of 50 million euros, which is 5 CR, 5 crore into 4.5% into 6 by 12. Whatever is the interest rate. Whatever is the interest rate, pay that. 5 crore into 4.5% into 6 by 12 into 6 by 12, which is 5 crores. I do the calculation, 11 lakh 25,000. I'll have to pay at the rate of 4.5%. At the rate of 4.5%. And if it is 6.5%, 5 crore at 6.5% into 6 by 12 into 6 by 12. 6.5%. 6.5%. 16 lakh 25,000. But I have already taken an FRA. What is FRA here? 3 by 9 FRA. Whenever they give two rates, the lower rate is for borrowing investment purpose and the higher rate is for borrowing. If you're planning to borrow, bank will give you loan at higher rate. And if you want to invest, bank will accept deposit at a lower rate. So 5.64, 5.94, 5.94. 5.94 is the borrowing rate. 5.64 is the investment rate. So I've already frozen at 5.94 with the bank. Actual rate is 4.5. Pay 4.5 and pay another 1.44 as settlement. You will effectively pay 5.94. You will effectively pay 5.94. So there is an FRA settlement. FRA settlement 5 crore into 1.44%. You have to pay extra 1.44%. Overall 5.94. Overall 5.94. So 5 crore into 1.44% you have to pay, which is 3 lakh 60,000. 3 lakh 60,000. But the benefit is, if the rate is 6.5, I have frozen at 5.94. I want to pay only 5.94. If I pay lesser, I was giving settlement. Now, if I paid more than 5.94, I will get back some settlement. I will get back some settlement. So 6.5 I pay, I receive back 0.56. 0.56. I receive back 0.56. Effectively, I'll pay 5.94. From 6.5, I receive back. How much I receive back? 5 crore into 6.5 minus 5.94, 0.56%, 6 by 12. This is receipt for me. And the earlier one was payment of mine, receipt and payment. So this number is 0.56, 1 lakh 40,000 receipt, 1 lakh 40,000. Effective interest outflow is total of this 14 lakh 85,000, 1125 plus 360 or 1625 minus 140, also 14 lakh 85. This is the beauty of forward rate agreement. It will ensure that I pay 14 lakh 85,000, which is approximately, what is effective interest cost? The effective interest cost is, I pay 14 lakh 85,000 on 5 crore on 5 crore into 12 by 6 into 100. This is the annualized rate I'm paying. 14.85 lakhs, 500 lakh, 12 by 6, 5.94%. Effectively, we are paying 5.94. FRA settlement amount, we do know that there is some discounting to be done, which you will see in the questions where only discounting is asked. Effective rate of interest they ask. Ideally, I should use the undiscounted amount. So this FRA settlement is undiscounted. Consistency is not there much in ICI solution. If they ask what is the settlement amount exactly made, there's something called as discounting to be done. Not relevant to this question, so I'm not discussing it. 5.94%. This is on FRA route. Then I go through interest rate futures route. I go through interest rate futures route. Again, same calculation. Actual interest rate 4.5%, actual interest rate 6.5%. First part remains same. Pay interest on loan 4.5, 6.5 you pay. There will be something called as futures settlement. Futures settlement. What is that? How much it is calculated? We will see. But the interest on the loan will be whatever is the rate. Whatever is the rate. 4.5 pay 4.5, 6.5 pay 6.5, 10.5 pay 10.5. You have to pay the actual rate of interest, and there is something called as a settlement to be done in the futures market, which I'll explain. In the futures market, 3-month futures contract, 3-month futures contract maturing in a period of 3 months is quoted at 5.85%. In the futures market, interest rate is 5.85. Interest rate is 5.85. Now, here they are saying it is 3-month contract maturing in 3 months. In the futures, there is a concept called mismatch of duration, mismatch of loan duration and future settlement period. Here, the future settlement period is 3 months. Loan duration is 6 months. So, what concept says is, I want to borrow 50 million for 6 months is equal to futures value into 3 months, because futures has a settlement of 3 months. 50 million into 6 months, futures value into 3 months, futures value into 3 months, 50 million into 6 months, futures value into 3 months, futures value into 3 months. So this gives me 50 million into 6, futures value into 3. I should take a futures contract for, if I do this, 50 into 6 divided by 3 for 100 million. Hedging is to be done for 100 million. Hedging is to be done for 100 million. I have to do hedging for 100 million. I have to do hedging for 100 million. There is a concept called mismatch between the duration of the loan and the future settlement period. You need more clarity, please see detailed concept videos. So 100 million, 100 million. Then number of contracts for hedging, number of contracts for hedging, 100 million, which is 10 cr, 10 cr divided by 50,000. 50,000 is the value of one contract. 100 million divided by 50,000, divided by 50,000. So 1,000, 10,000, lakh, 10 lakh, crore, 10 crore divided by 50,000. Some 2,000 contracts. I have to do 2,000 contracts. Number of contracts for hedging is 2,000 contracts. Futures also go through a net settlement route. How does it go through a net settlement route? Let's understand this. Same thing I wrote earlier, no? Date, spot, futures. Day 0 and I borrow it on day 90. Day 0, spot and futures. Day 0, spot and futures. Day 0, the interest rate, spot rate is 5.75. That's a spot borrowing rate. I cannot borrow it today, but I freeze the futures rate. What is the futures rate? 5.85. I borrow freezing at this rate. I borrow freezing at this rate. That is, I'll pay interest of 5.85. I'll pay interest of 5.85. I borrow it at this rate. I freeze the rate. On the actual date, that is day 90 when I borrow, this 4.5%. No data, so this is also 4.5%. To cancel this, you have to lend. Borrow at 5.85, lend at 4.5%. Borrow at 5.85. This is futures market. Spot is separate calculation. Futures is separate calculation. Borrow at 5.85%, lend at 4.5%. There is going to be a loss of 1.35%. Loss of, because I borrow at a higher rate and lend at a lower rate. Lend at a lower rate. How do I convert this into rupees? Loss in rupees is equal to 20,000 contract into 50, sorry, 2000 contract. Sorry, 2000 contract. 2000 contract into 50,000. Now comes the beauty, into 1.35%. 3 month settlement period means 3 by 12. You cannot do 6 by 12 here. You cannot do 6 by 12. We normally calculate interest for 6 by 12. But futures have a settlement of 3 months. So into 3 by 12. Into 3 by 12. Normally we do 6 by 12. Futures have a settlement of 3 by 12. So into 3 by 12. 2000 into 50% into 1 point into 50,000. So 2000, let me do the calculation. 2000 into 50,000 into 1.35% into 3 by 12. This is my loss. This is my loss because loss is 337,500. Loss is 337,500. I borrowed at 5.85, cancelled it at 4.5. That is futures, always you have to do a cancellation opposite. Any futures you have to do an opposite question. 337,500. 337,500. So futures 337,500, payment bias. Payment bias because it's a loss. Same thing. Instead of 4.5, the rate is now 6.5. 6.5. I lend at 6.5. If you lend it at 6.5, borrow at 5.85, borrow at lower rate, lend it at higher rate, borrow at lower rate, lend it at higher rate, you make a profit of 0.65%. Again, same thing. 2000 into 50,000 into 3 by 12. This is a profit. 0.65% into 2000 into 50,000 into 3 by 12. 3 by 12. 0.65% into 2000 into 50,000 into 3 by 12. Profit. Once I write it as negative because this is inflow for us. The first one is outflow. Second one 337,500 outflow. This side 162,500 inflow. Net amount. Again, it's the same thing. It's a very good question. 1125 plus 337,500. I pay 1462,500. This side again it will be same. 1625 minus 162,500. I pay 1462,500 and we'll do the percentage. We'll get 5.85 percentage. We'll get the same 5.85 percentage. A slightly different question. Little more explanation. Around 15 minutes I have spent. Every other question we have spent only 10 minutes. This question alone 15 minutes because slightly unique. Students have found it little difficult to understand. That is why I said, let me go ahead and explain little more. Clear? With this, question 7 gets over. The explanation on 7 is over. Okay, let's move to question 8. A little lengthier question. X Limited invested on 1/4/2009 in certain equity shares as below. Name of company, number of shares and cost. M Limited, N Limited, 1 lakh shares, 100 each. 2 crore is the cost. 50,000 shares, 10 each. 1 crore 50 lakh is the cost. That 110 is the face value. The purchase price is obviously 2 crores divided by 1 lakh, which will be 200. 2 crore divided by 1 lakh, 200, and 1 crore 50 lakhs divided by 50,000 is 300. In September, 10% dividend was paid out by M Limited, and in October, 30% dividend was paid out by N Limited, and closing prices 220 and 290. Closing prices 220 and 290. So I invested at 200, it became 220, dividend I got. I invested 300, it became 290, and dividend I got. So loss in one, profit in one. Then they're saying on 1/4/2010, the probability of dividend from M Limited and N Limited. So these are the dividends I can get from M and N, and these are the price per share. 220, 250, 280, 290, 310, 330. I have to calculate what is the return from the portfolio for the year ended 31st March 2010, return from the portfolio for the year 2010-11, and comparative risk of the two investments by calculating standard deviation, by calculating so return and standard deviation. Now coming to M Limited, in M Limited first year we invested at the rate of 200, price at the end is 220. We invested at the rate of 200, price at the end is 220. So 220 minus 200 plus I get a dividend of 10% of face value, which is 10, whole divided by 200. 15% I earn in M Limited. I earn 15% in M Limited. When it comes to N Limited, 290 is the closing price, 300 is the investment price. So I will suffer a loss, P1 minus P0, and dividend is 30%, 30% of 10. Dividend is 30% of 10 rupees, which is 3 rupees on 300, negative 2.33%. This is first year. They want portfolio return. Portfolio is overall investment which I did. So portfolio return format remains the same, liability, beta, weight, product format. So here security, return, weight and product. Security, return and weight, product is standardized format we have. M Limited, N Limited, M Limited I earn 15%, N Limited I earn 2.3333 percentage, 2.33333 percentage, 15% and 2.333 percentage. Weight is what is the investment we are making, 2 crore. 2 crore is the investment we make, and 1 crore 50 lakh is the investment we make. Multiply these two. Product is technically the return I make, 15% on 2 crore. I earn 30 lakh, 2.33% on 1 lakh 50, negative. This is negative, sorry. This is negative return. Second one is negative return. So overall we earned 26 lakh 50. Overall we invested 3 crore 50, and overall return is column 2 into column 3 is column 4. You divide 2650 by 3 crore 50, 2650 by 3 crore 50. We earn a return of 7.57%. First year return is very simple calculation. 7.57% is the return I earn in the first year. I earn in the first year, which is 2009-10. 2010-11 is a very tricky calculation because there is a dividend whose probability are given. There is a price whose probability are given. I invested for the first year over. Second year I started 220. I started 220. I'll do the calculation for M Limited. N Limited, a similar calculation is to be done. So dividend can be 10, 15, 20. Price can be 220, 250, 280. It can be any combination. So listen. So we'll say probability for dividend, probability for dividend, probability for price and price. There's something called as joint probability. As we do, you'll understand. Probability for dividend, probability for price and price. They have given the probabilities are 0.2 and 0.3 and 0.5. Dividend can be 10% of 100, 15% of 100 and 20% of 100, 10 rupees, 15 rupees, 20 rupees. The price, if, or let me write this dividend 3 times, you'll understand why we are writing 3 times. 0.2, 3 times I'll have to write. Then 0.3, 3 times we have to write. And then 0.5, 3 times we have to write. Why this 3 times? You'll understand in a minute. With this, when dividend is 10 rupees, your price again has 3 probability. 0.2, 0.5, 0.3, 220, 250, 280. When the dividend is 10 rupees, these are the prices. When the dividend is 15 rupees, again 3 prices. When the dividend is 20 rupees, again 3 prices. Again 3 prices. Now, my return is return in rupees. Return in rupees. What is return in rupees is I invested originally at 200. That is over. That is history. Now, next year, the opening price is 220. The opening price is 220. 1 year is over. 1 year is over. Now the price is 220. You can earn 10 rupees dividend. So 220 minus 220 is the capital appreciation plus dividend. 220 minus 220 plus dividend. 250 minus 220 plus 10 rupees dividend. 280 minus 220 plus 10. 220 minus 220 plus 15. 250 minus 220 plus 15 goes on like this. This is the return I get. This is in rupees. We calculate in percentage. We calculate in percentage, return in percentage. It's a very lengthy computation. I can't help it. You may do it in two different tables because you will need a lot of columns. Return in rupees, return in percentage. What is percentage? 10 rupees on my 220. On my 220. 10 rupees on my 220. On my 220. So 10 divided by 220 into 100. These are the returns I generate. 4.55%, 18.18%, 31.82%, 6.82%, 20.45%, 34.09%, 9.09%, 22.73%, 36.36%. These are the returns we can generate. The returns which we generate is 4.55, 18.18, 31.82, 6.82, 20.45, 34.09, 9.09, 22.73, and these are the returns I generate. And we use a format called return, probability, product, deviation, PD square to calculate the weighted average return and standard deviation. Return, probability, product, deviation, PD square. What is probability? Is joint probability. What is joint? Is dividend probability into price probability. Dividend probability into price. So dividend probability is 0.2, price probability is 0.2. Both together happening is 0.04. 0.2 into 0.2. Then 0.2 into 0.5. Like this it goes on. The overall total will obviously add up to one time. These are the joint probability. Return, probability, now product. These columns and all I should not even explain. Deviation, PD square. Product, deviation and PD square. In Excel I can do it faster. At your end it will take a lot of time in exam. Probability, return into probability. Return into probability. We put a total. This is the weighted average return, 22.5%. Return into probability. Return into probability. What is deviation? Return of that minus the weighted average, 22.5. Weighted average is 22.5. This is the deviation. And probability into deviation into deviation. Probability into deviation into deviation. Do it for all the 9. Put a total and square root of this is standard deviation. They wanted standard deviation return. Return is 22.5. Standard deviation is square root of 94.24, which is some 9.71%. Like this, I have to do it for both of them. So you see the calculation here: 22.5, 94.24, 9.71%, 9.71%. Like this, you do it for the other one also. It's a very lengthy calculation. 8.5 and 4.84%, 8.5% and 4.84%, 4.84. If you want even rupees, see, standard deviation can be in percentage, can be in rupees. What we calculated is percentage, multiply with the original price. Original is opening price. You'll get it in rupees. Standard deviation is normally in percentage. Then I have to now calculate a similar return. But the only thing is weights will change. Why does it change? Let's understand it. Return M limited 22.5%. M limited 22.5%. N limited return is 8.5%. Now, when I come to this year, I have opening. Always investment is what is opening value. What is opening value? When you did 2009-10, it was 2 crore. Now it is 1 lakh into 220. 1 lakh into 220. 1 lakh into 220. 1 lakh into 220, which is 2 crore 20 lakhs. 2 crores 20 lakhs. And then 50,000 into 290 opening. 50,000 into 290 put together. Percentage some 16.94. It's a very formality. This format is very useful. Security, return, weight, product format is very, very useful. Many of my students know the benefit of this. So you use this format, you will keep getting to the answer. A little bit more time I think I've taken in this question, around 11-12 minutes. My target is to do every question maximum in 10 minutes. That is the target. With that, we are discussing these MTPs, RTPs, so that it is easier for you to quickly go through it and understand the crux. With this, question number 8 gets over. Okay, let's move to question 9. This may need little bit more explanation. It is covered in my question bank, but for other students, maybe this concept could be slightly new. It is covered in, I think, one of the MTP RTP in the past, and that is why I covered it in my question bank, but it can be little challenging. On 1st February 2020, XYZ, a laptop manufacturer, imported a particular type of memory chip from SKH Semiconductor of South Korea. Payment is due in 1 month from the date of invoice, amounting to 1190 million SKW, 1190 million, 119 CR. Following spot exchange rates are quoted in two different markets, USD slash INR. But looking at the rate, this is INR per USD. This is INR because 85 can't be USD per INR. So second one has to be SKW per USD. Second one has to be SKW per USD. First one is INR per USD. Since hedging of foreign exchange risk was part of the company's policy and SKW hedging is not available, I went for a non-deliverable forward market. What is non-deliverable forward contract? Is forward contract we normally do delivery. In case non-deliverable means there will be a net settlement. There will be a net settlement. Non-deliverable forward market. Non-deliverable forward market is basically net settlement. There will be a net settlement for hedging the same risk. In NDF market, a dealer quoted 1 month USD SKW. The problem is the NDF market also doesn't have INR SKW. It has USD SKW 1390.60 to be settled at the reference rate declared by Bank of Korea. Bank of Korea. After 1 month, the dealer said we will have a settlement at 1385 because it's a net settlement. It is a net settlement. USD slash INR, USD slash SKW, that is INR per USD. Analyze the position of each company, under each of the following cases, comparing with spot. Comparing means comparing with what happened today. Do nothing, opting for NDF, both rupee per SKW rate and final payment, which is to be computed in lakhs. The data is in millions, you have to do it in lakhs. 4 decimal point, rate up to 4 decimal point, rate up to 4 decimal point. First is, if I had made the payment today, what is the outflow? If I don't do any hedging, and I make the payment, if I don't do any hedging and I make the payment after 1 month, the difference between this is the profit or loss of do nothing. Profit or loss of do nothing. Then NDF contract, what happens, we'll understand. So first is outflow today. Outflow today for the exposure. Outflow today for the exposure. Outflow today, because they have said us to compare, otherwise this calculation is of no use. Today calculation is not needed. They said comparing with the spot position of 1st February. Exposure amount we'll do it in lakhs. Okay, 11,900 lakhs SKW. 11,900 lakhs SKW. I am a laptop manufacturer. I have imported, so I need to buy this. I have imported it. I need to buy this. I need to convert. This is known component. This is technically called as known component. Unknown component, I have to convert into INR. Unknown component, question mark, INR. Technically, if you are buying SKW, you will be selling INR. You will be selling INR. So our calculation is INR is equal to SKW into INR per SKW. SKW will get cancelled. Denominator is SKW. We are going to buy SKW. Bank is going to sell us. We are going to buy SKW. Bank is going to sell SKW. Bank will sell it at the ask rate. We'll have to expand this formula. 11,900 into ask INR per USD into USD per SKW. INR per USD into USD per SKW. 11,900 into ask rate, which is given in the question, I think. INR per USD ask rate today is 85.5. USD per SKW is not given. It's SKW per USD. It's SKW. So 1 by bid into 1 by 1390. The decimal portion, that is this rate, you have to convert into 4 decimal. You have to convert into 4 decimal, and then do the calculation. You have to convert into 4 decimal and then do the calculation. 85.5 divided by 1390. 85.5 divided by 1390. 4 decimal they have talked about. 0.0615. 85.5 divided by 1390, and then we multiply with the payment 11,900. 731.85 lakhs payment if I pay today. If I pay today 4 decimal, can I do 11,900 into 85.5 and do? You may get a slightly different answer. I feel ICA would have done this way only. 731.85 lakh. The 4 decimal rate you calculate and then do the multiplication. This is outflow today. Then outflow after 1 month with no hedging. Outflow after 1 month with no hedging. With no hedging, same thing. INR per SKW, everything same, just that the rates are going to be different. Rates are going to be different. It is not 85.50. The rates have turned out to be 85.75. 85.75 and 1 divided by 1388. 1 divided by 1388. INR equal to 11,900 into 4 decimal rate. 4 decimal rate. 85.75 divided by 1388. Yeah, 1388. A fairly simple calculation. All the students struggle, but my students will know that how we do it in a very simple way. 0.0618. 735.42 lakhs. The gap is profit or loss. I'm paying more. So loss if no hedging is done. Loss if no hedging is done. 735 minus 731. 3.57 lakhs if I do nothing. If I do nothing, there is a loss of 3.57 lakhs. There is a loss of 3.57 lakhs. Then comes the NDF market. NDF market will go through a net settlement route. NDF market will go through a net settlement route. I have a problem with the NDF here. I wanted a contract for INR SKW. I wanted a contract for INR SKW. The contract I wanted was INR SKW, but I have taken USD SKW. I have taken USD SKW. So for this, first is net settlement. Net settlement. Once the net settlement is calculated, you will add that profit or loss to this 735. 735 is the spot settlement. What is your outflow going to be? 735 plus or minus the net settlement. Plus or minus the net settlement. So what is net settlement? Date. Most of my students will know this. Date, position, action, reference date, and rate. Date, position, action, reference date, and rate. Day 0, original position. Day 0, original position. Original position. Day 0, original position. The contracted rate is for SKW per USD. USD is the product currency. USD is the product currency. SKW per USD. I want to buy SKW, which means I want to sell USD. Day 0, SKW per USD. The original contract is SKW per USD. I wanted INR per SKW, but that's not there. SKW per USD. I plan to buy this currency, which means we will sell US dollar. So originally we entered into a contract to sell. Sell will happen at bid rate. We are going to sell it at bid rate. We are going to sell it at bid rate month 1. Month 1. We are going to sell it at bid rate. Bank will buy at what rate? SKW 1390 per USD. SKW 1390 per USD. Then settlement happens month 1. Opposite position. Buy, ask, I come back at the month 1, and the settlement they have said 1385. Settlement rate is 1385 per USD. So my selling rate is more, buying rate is less. I make a profit. I make a profit. How much profit I make? I make a profit of SKW. I make a profit of SKW 5 per USD. I make a profit of 5 SKW per US dollar. Per US dollar. Now, one thing I did not know is what is the exposure amount. Exposure is, they had said 1190 million. 1190 million. For how many contracts did I take? That calculation we have to take, because they have given 1190 million, but our contract is not in SKW. Our contract is in US dollar. Our contract is in US dollar. So contracted USD is 11,900 lakhs SKW divided by 1390. The rate was 1390. This is the contracted amount. 11,900 lakh SKW divided by 1390. Divided by 1390. 8 lakh 56,115. This is the contract dollar. Very good question, because they had given the exposure in SKW, but the contract is in US dollar. Exposure is in SKW, contract is in US dollar. Contract is in US dollar. Exposure is in SKW, contract is in US dollar. Contract is in US dollar. I took the original contract at 1390 SKW per USD. Per USD. That is the sell contract. Opposite is the buy contract. I make a profit. Overall profit is 5 SKW into 856,115. 5 SKW into 856,115. 42 lakh 80,575 SKW. This is the profit I made. This is a profit I made. 42 lakh 80,575 SKW is the profit we made. You see the calculation here. We made a profit of 42 lakh 80,575 SKW. This is the profit we made in SKW. This is the profit we made in SKW. 8.5612 lakh. This I convert into dollar, because dollar is going to be used. Settlement rate is given, which is 1385, and I get US dollar 3000. US dollar 3000. This is the profit I make in ND of contract. Profit I make in ND of contract is USD 3000. I'll convert this USD 3000 into the INR at the actual rate. You are going to sell dollar, bank is going to buy dollar, bank will buy at the bid rate into 85.50. Into 85.50 is an extra profit for us. So 3091 INR 2.6428. Your settlement is 735.42 and a profit of 2.6428. Final outflow is 732.7772 lakhs. Final outflow is 732.7772 lakhs. I'll explain this part little again. Under a forward contract, delivery is normally made. Settlement will happen. In case of NDF, delivery will not happen. Delivery will not happen. So what we did, we wanted to buy SKW. We will be selling US dollar. US dollar sell will happen at bid rate. I divide by the bid rate. I get the number of exposure amount in dollar. Original contract sell. Opposite is buy. Profit is 5 per US dollar. Converted 5 into 8.56 lakh. And using the settlement rate, overall profit is $3,091. Convert into INR. You make an extra profit of some 2.6428 lakh. This 2.6428 lakh will be reduced from your spot outflow. NDF net settlement. NDF net settlement. So spot settlement will be there, and then you will deduct this 2.6428, 732.7772. Compare with the original rate. Compare with the original rate. In case you want more explanation on this question, I have uploaded the question which I did in class, where I did a 30-35 minutes kind of an explanation. You want a lengthier explanation, you can go through that question, which is my class problem. I've uploaded again in a playlist called AFM Concepts. There is a playlist called AFM Concept where I've uploaded the NDF video. But this I wanted to do in maximum 15 minutes kind of thing. So that is why I have not explained in depth and all. But still, I know what I wanted to explain. So everything is explained here. NDF goes through net settlement route. NDF goes through net settlement route. You compare with the original 0.9272. So loss is 0.9272, not no hedge. Loss under NDF. Loss under NDF is 0.9272 and loss under no hedge is 3.57. Obviously, I'll go for NDF. I'll obviously go for NDF. That will ensure that I have lower loss. That will ensure that I have lower loss. With this question gets over. Okay, let's move to the next question, which is from Forex. A fairly simple question. Shanti exported 400 pieces of a designer jewelry to USA at $400 each. To manufacture and design this jewelry, she imported raw material from Japan, whose cost is JPY 12,000 for each piece. Labor cost and variable overhead incurred in producing each piece of jewelry is 2,600, 1,300. Today, the spot rates are rupee per dollar and Japanese yen per dollar. Shanti is exporting that by the time the remittance is received and payment is made, you are required to calculate the resultant transaction exposure. What is resultant transaction exposure? I'll calculate the profit or loss if payment happens today. Receipt happens today itself using today's exchange rate. Then I'll calculate another one using the other exchange rates which are given. One using today's exchange rate, another one using the later exchange rate. One using the today's exchange rate, another one using the later exchange rate, another one using the later exchange rate. One using today's exchange rate, another one using the later exchange rate, another one using the later exchange rate. What is that? Let's understand it. If we do it using today's rate, if I do it using today's rate itself, you'll understand that itself is kind of sufficient. Particulars, calculation amount, profit if calculation is done as per today's rate. Revenues is I have 400 pieces into $400. This will be converted into INR at the bid rate. Bid ask, if you have a confusion, you will have to do the detailed known component, unknown component into 80 rupees, into 80 rupees. This will be my realization today. 400 into 400 into 80. I'll do 1 crore 28 lakh. 400 into 400 into 80, 1 crore 28 lakh. Then less costs. In the cost, we have multiple costs to manufacture and design this jewelry. She imported raw material from Japan, at a cost of Japanese yen 12,000. Raw material cost is, this is little, you'll have to again, I will prefer you to do known and unknown. 400 into 12,000 Japanese yen. I have to convert the Japanese yen, which is INR is equal to JPY into INR per JPY. INR per JPY. JPY is my denominator currency. I'm going to buy JPY. Bank will sell it at the ask rate. So I will do 12,000. INR per JPY is INR per USD. INR per USD into USD per JPY. I need the ask rate, which is 81 into USD per JPY. USD per JPY, I will use 1 by bid rate. USD per JPY, 1 by bid rate. 1 by bid rate. So into 81 into 1 by 135. 1 by 135. 400 into 12,000 into 81 divided by 135. We get 28 lakh 80,000. 28 lakh 80,000. It was 81 by 135. 0.6. So 400 into 12,000 into 0.6. So 400 into 0.6 into 12,000. Technically 28 lakh 80,000. From thereafter, we have other cost, like we have in this question labor cost. Very simple. 400 units into 2,600. 400 into 2,600. 400 into 2600, which is 10 lakh 40,000. And then we have another cost is variable overhead, which is 1300 per unit. Variable overhead 400 into 1300 into 1300, 400 into 1300 into 1300, 5 lakh 20. And this will give me profit as per today rates. Profit as per today rates. Profit as per today rates 83 lakh 60,000. This is profit as per today rates 83 lakh 60,000. Profit as per today rates 83 lakh 60,000. We'll have to repeat the same calculation which I'm just discussing using the final rate, which is 84.25. Your realization will be at 84.25, and this will be 12,400 into 12,000 into 83, sorry, not 84 point, sorry, 83.90 bid rate, 83.90, and into 84.25 divided by 125, divided by 125. So 32, 35, 200, 32, 35, 200. I make a profit. So there is an increase in profit. Transaction exchange rate is favorable for me. Exchange rate is favorable for me. I'm making more profit. I'm making more profit. Increase in profit due to transaction exposure. I think this question we have done it in 5 minutes. On an average, I want 10 minutes. So last question took more time. This question saves me time. 10 minutes per question is the mantra we are doing here, so that you are able to cover the entire RTP in shorter time. Entire RTP in shorter time. Clear? With this question discussion gets over. Okay, we move to the next question, which is from mergers and acquisition. To a great extent, fairly simple question. We have a standard format by which we can get this answer. C Limited and P Limited, both companies operating in the same industry, decided to merge and form a new entity, S Limited. Relevant financial details of the two companies prior to merger announcement are as follows. Particulars: C Limited, P Limited, annual earning after tax 10,000, 5,800, number of shares outstanding 4,000, 1,000, P ratio 8 and 10. Merger will be effected by means of stock swap. Stock swap, 3 shares of C Limited for 1 share of P Limited, 3:1. After the merger, due to synergy effect, annual earning post tax is expected to be 8% higher, 8% higher than the sum of the individual earning. Further, it is estimated that P ratio of S Limited shall be average. Average can be simple average, weighted average. ICI, I think, has taken simple average. Simple average shall be average of 8 and 10. Evaluate the extent to which shareholders of P Limited will be benefited per share. What is the benefit for shareholders of P Limited? What is the benefit for shareholders of P Limited from the proposed merger at a per share level? At a per share level, we have a standardized format. You put it in that format. Again, every question I believe in standardized formats. So question 11. Question 11. Particulars and three columns. Particulars, C Limited, P Limited and merged. Particulars, C Limited, P Limited and merged. We start with PAT, number of shares, EPS, P multiple, MPS, number of shares and market value of firm. This is the format I follow for every question, and if you have followed my videos, you will understand this format. Very simple. The PAT given in the question is 10,000, 5,800. Put together is 10,000 plus 5,800, and they have said extra 8%, higher than 8%. So into 1.08, into 1.08, 15,800 into 1.08, 17,064. Number of shares 4,000, 1,000, 4,000 plus. I'm going to give 3 shares of C Limited for every 1 share of P Limited. For every 1 share, so 1,000 into 3. 1,000 into 3, it becomes 7,000. Divide it 2.50, 5.80. If I get it in decimal, I'll make it as 4 decimal at the EPS level 2.4377. 2.4377. P multiple is 8, 10, average is 9. Average is 9. 20, 58. 20, 58. EPS into P multiple 2.5 into 8. 2.5 into 8. This is 5.8 into 10 into 10, and this I will make it 2 decimal in the end, 2.4377. 21.94. Beyond this, I'm not doing it. I can do it also, but anyway, per share level only they've asked. What is the profit for shareholders of P Limited? I today had one share of 58, and now I have three shares of 21.94. I have three shares of 21.94. So my profit is 65.82. From 58, I'm becoming 65.82. Evaluate the extent to which shareholders of P Limited, only P Limited they've asked. Today, one share of 58 rupees. Tomorrow, three shares of 21.94, 65.82. Profit is some 7.82. Profit is there. I have done this, but technically I don't need all this. Profit is 7.82. I've done a lot of calculation. Direct answer I get got. Profit is 7.82 per share. Profit is per share level 7.82. Overall analysis done. Here I've done per share analysis. Profit is 7.82 per share. Only shareholders of P Limited they've asked. Fairly simple, straightforward question. With this question gets over. Okay, now I move to question 12. We are almost at the end of the RTP. I think around 1.5 hours to 2 hours is the discussion we would have had totally. Coming to question 12, this is on return computation. A mutual fund raised 150 lakh on April 1, 2018 by issue of 15 lakh units at 10 per unit. Fund invested in several capital market investment to build a portfolio of 140 lakh. Initial expenses 8 lakh rupees. During the month of April, fund sold certain instrument costing 44.75 lakh for 47. Costing, this information is critical. You will understand the importance of this when we do the question. 44.75 for 47 lakh, and used the proceeds to purchase certain other security. Fund management expenses 6 lakh, of which 50,000 was in arrear. Fund earned dividend of 1.5 lakh, distributed, this line is very critical, 80% of the realized earning. Market value is 147.85. I am an investor who bought 1000 units on April 1, 2018, disposed it off on 30th April. So I want to calculate the earning of this investor. He bought it on April 1, 2018, that is at 10 per unit. He would have sold it on 30th April at what NAV? We don't know. That is the calculation. And he would have got some dividend income. Now, in this question, they have given all the cash flows. So we have to first calculate the closing cash balance, because NAV calculation, all assets minus liability divided by number of units. All assets minus liability divided by number of units. All assets minus liability divided by number of units. So in all assets, one of the assets is cash balance. So working note 1 will be closing cash balance. I'll have to compute the computation of cash balance, particulars calculation amount, calculation amount. In this, we start with inflow from unit holders. 150 lakh on April 1, 2018. So 150 lakh is the inflow from unit holders. 150 lakh rupees. This fund invested in several capital market investments. So I got 150 lakh. I invested less outflow on shares purchase. 140 lakh went. Outflow on shares purchase 140 lakh went. I also did some initial expenses, less initial expenses. We are just evaluating the cash flow. 8 lakh gone. Then they are saying I sold certain instrument. If you sell, it is inflow. Why cost is given? In 2 minutes you'll understand. Sold certain instrument, costing, that will park it for the timing. Add inflow from shares. 47. Inflow from shares 47. and use the proceeds. We bought again, less purchase 41.6. I purchase other share 41.6. Fund management expenses 6 lakh, of which 50,000 is an arrear. So we have paid fund MGMT expense, fund management expense paid. Of the 6 lakh, 50,000 is an arrear, 5.5 lakh paid. This is in lakhs, okay? 5.5 lakh paid. Also earned dividend earned inflow. Add dividend earned. I earned a dividend of 1.5 lakh. I earned a dividend of 1 lakh. Fund earned dividend amounting to 1.5 lakh. And next, less. This is the important part. Dividend paid. What it says, 80% of the realized earning. What is realized is 1.5 lakh of dividend. Realized means what I've got. And in this, there is a profit. This is the important part. There is a profit of 2.25 lakh. This is realized earning. 44.75 cost, sold it for 47. 44.75 cost, sold it for 47. 44.75 cost, sold it for 47. 2.25 lakh profit. So 80% into 1.5 plus 2.25. 80% into 1.5 plus another 2.25. 80% into 1.5 plus another 2.25. 3.75 into 80%. So this is dividend paid, and this will give me closing cash. This will give me closing cash. So many transactions we have done. Closing cash. Closing cash is 0.4, 0.40, 0.40. After this, the unit holder will go out. There some cash reduction will happen, but as of now, 0.40. NAV calculation. I have an asset of 147.85. I have an asset of 147.85. Cash balance of 0.4 and liability of 0.5. Fund management expense not paid. Fund management expense not paid. Liability of 0.5. 147.85 plus 0.4 minus 0.5. 147.75 divided by 15. Divided by 15. 9.85 is the closing NAV. I bought it at 10 and selling it at 9.85. Some loss is there. That's okay. So annual rate of earning is equal to NAV 1 closing, NAV 0 plus I got some dividend income divided by NAV 0 into 12 by M into 100. 9.85 minus 10. Dividend is 3 lakh is the dividend paid. 3 lakh is the dividend paid for 15 lakh unit. I am a unit holder. 1 unit I am calculating. 3 lakh on 15 lakh. On 15 lakh unit. So 3 by 15, which is 20 paise, divided by 10, 1 month calculation. You can do into 365 by 30 also. Slight variation in answer will happen. So 9.85 minus 10 plus 0.2 divided by 10 into 12 by 1 into 100. 6% is the annual rate of earning. Very simple question. 6%. You have to track the cash. You have to track the cash, and the return is 6%. The return is 6% here. Return is 6% here. See the calculation, 9.85. 6%. Annual rate of earning is 6%. Fairly simple, straightforward question. With this, question 12 discussion gets over. Okay, we move to the last question. Balance or theory related question, which anyway I'll not discuss it. Treasury desk of a global bank incorporated in UK wants to invest GBP 200 million. GBP 200 million. Treasury desk of a global bank incorporated in UK. UK, their currency is GBP 200 million for a period of 6 months, and has the following option. Equity trading desk in Japan says we can invest it in high dividend yielding Japanese securities. High dividend yielding Japanese security that will earn a dividend income of JPY 1182 million. Dividends are declared and paid on 29th June, and post dividend the securities will quote at a 2% discount. Desk also plans to earn JPY 10 million on a stock borrow lending activity. I'll lend the shares. The securities are to be sold on June 29 with a T+1 settlement, and the amount will be remitted back to London. So I can invest in Japan. Another option is to invest in US, where I'll get a return of 5%. exchange rate given GBP JPY, GBP slash hyphen JPY. This will be JPY per GBP looking at the exchange rate. So second one has to be USD per GBP. Now we have to decide where, as a treasurer, advise the bank what would be a decision from a risk perspective. You may ignore taxation. You may ignore taxation. So I can invest in the Japanese yen, or I can invest in US dollar. Let's first do Japanese yen investment. So I have amount on day zero. Amount on day zero. I have an amount of GBP 200 million. We are doing it in millions. Okay. Amount on day zero, I convert this into Japanese yen. I convert this into Japanese yen at the rate of 200 into 148.0002. So this becomes Japanese yen 29600.04. Japanese yen 29600.04. This is on day 0. June 30, what happens is June 30, which is the last day. June 30, what happens is I get dividend income. Japanese yen JPY 1182. 1182. This is JPY. I also get stock lending income, which is 10 million. 10 million again Japanese yen, and sale of shares. I bought it 29600.04. When I sell it, 2% discount. 2% discount. 29600.04 into 98%. Into 98%. Into 98%. Inflow on June 30. Inflow on June 30. Overall amount is this much. 30,200, if at all I want, 0.0392 Japanese yen in millions. I now remit it back to my investment place. Where do I remit it back? I remit it back to the global desk of UK. I invested at 148.0002. I remitted back at the rate of 150. So final inflow on June 30 in our cash flow on June 30 in GBP, divide by 150. Divide by 150. Divide by 150. 201.3336 GBP. 201.336 GBP. This is what I will, my 200 million will become 201.3336. I can increase the number of decimal also, but 201.3336. If I increase, because later on you'll understand you may have to increase this. This is the amount. This is if you invest in Japanese yen. If you invest in Japanese yen, 200 becomes 201.33336. Second option is same calculation. GBP 200, but I'll invest in US dollar. US dollar. US dollar rate on day 1 is 1.28. 200 into 1.28. USD 256. USD 256. USD 256, and we earn here fixed income. Fixed income means there's no change and all. So 256 will remain 256. 5% per annum, 6-month investment. Interest income 256 into 5% into 6 by 12. 256 into 5% into 6 by 12. US dollar. Maturity amount same 256. Total inflow in US dollar. In US dollar 256 plus 6, and I convert into GBP. Convert into GBP. 262 divided by 1.30331. 201 point, same, almost 3335. This is GBP amount. GBP amount 333528, and there it is 333595. Almost same amount. So where I can invest, there's a very marginal difference. But what would be your decision from a risk perspective? Also, you have to see what is return perspective and risk perspective. Return is almost the same. Risk is US is fixed income. So investing in bond is obviously less riskier than investing in equity. Here you are doing equity investment. With equity also you get almost same amount, and with debt also you are getting almost same amount. I'll obviously go through debt investment. So my approach will be, if I look at from an amount point of view, Japanese yen is preferred, but very small difference. Nothing much is there. It's a very marginal gain. But a risk perspective, which is the most important, I should invest in G6. I should invest in government security as they are risk free. As they are risk free. With this question gets over. 14A and all I'm not discussing. These are theory oriented question. We have our theory videos. You can see them if you want, or you can go through this. With this RTP discussion gets over. You can comment in case you want me to discuss any other MTP RTP. I'll try to discuss that MTP RTP. With this MTP RTP discussion gets over. Thank you friends. Prepare well. Do well in your exams.